Hi guys, this is Economics Chapter 5, CFA Level 1, National Income. National Income Part 1, Introduction. In this chapter, we are going to focus on macroeconomics. In macroeconomics, we study economic agents as a whole. Individuals, firms, households, and businesses, and economy as a whole. These are economic agents. So we study their behavior as a whole, which is the story and analysis, is the theory and analysis of nations, income and output, competitive and comparative advantages, labor force productivity, price level and inflation, government and central bank policies. What are these? We are just going to study in a moment. Aggregate output and income. Aggregate output of an economy is the value of all final goods and services produced in a period of time. Normally, we count this period in 1 year or 1 quarter. So this is the total output which a nation or which an economy is going to, or which a nation is producing in 1 year or 1 quarter. That is called aggregate output. Aggregate income is the value of all payments earned by the suppliers of factors of production. So we have 4 factors of production, which are labor and capital and land, labor, capital and organization. So wages are paid to laborers, rent is paid to the owner of land, rent is paid to the owner of capital, and profit is the difference between revenues minus all these is profit, which goes towards the owner or manager of the business. Aggregate expenditure is the total amount spent on goods and services in an economy. Actually, total of these both and this are same. We see in our next slide. Gross domestic product, GDP, is the market value of all final goods and services produced within the economy in a period of time. So normally this is the period which is 1 year. This period is normally 1 year. So there are 2 or 3 points needs to remember here in gross domestic product. Market value, we are going to study the market value, not the value which is included in the production of those goods, but the market value. Final goods and services. Final goods and services means we do not count the intermediate goods or raw material or anything raw which is not ready to use, but we are going to study the value of those goods and services which are ready to use either by households or by businesses, governments or any sector. Produced within the economy. So they are produced within the economy in our country, in a period of time, or normally that time is 1 year. Okay. Expenditure approach. We calculate the gross domestic product with these two methods. Actually we come up with the same figure. First one is expenditure approach. Let me have some pointer which is more visible. And this is our first one is expenditure approach. Expenditure approach, the amount spent for all goods and services. Whatever we earn, that we expend on everything is spent by ourselves or by spend anyone, actually, which is earned. So whatever everybody earns as a whole is going to spend on goods and services. So the total amount which we are going to spend, that is our GDP. Our second one is income approach. What are we are going to earn in an year, that is aggregate income. Key elements of GDP. If you have any question, you can actually message me, you can comment me, I can explain it. This video is basically to show in an overview. If you need any clarification on expenditure or income approach or any concept, you should message me in comments. Okay, key elements of GDP are represents all goods and services produced during the period. Number one, exclude transfer payments. Transfer payments are like which we earn or pay without any consideration, which we do not work and we are getting. Those are called transfer payments. For example, pension. Exclude capital gains. If we have some land and we sell it for a profit, that is not included in the GDP determined by the sold in the market. So what we are going to sell in the market, the price which we actually get, that is included, not anything else. Okay, it includes only final goods, not intermediate goods. uh, it means we cannot add up wheat, market value of wheat, but the market value of breads and other things which are made from bread like cake or biscuits. The value of those biscuits and breads and cakes, that is included in the market value of wheat, not the wheat. Okay, there are two other methods which can be used for either income approach or expenditure approach. That is receipts from the final customers. What we are getting from our customers are that is total that can be included, or value added at each stage of customer. Value added means when we produce wheat, we can add the value of wheat plus when owner of a bakery purchase that wheat and make some loaves of bread and sells to in the market, the addition he made through the wheat, the value he added in the value of wheat, that is added. So at each stage we are going to add the what producer or a manufacturer adds in the that raw material that can be added, and at the last we are going to get the GDP. Okay, normal versus real GDP. A real GDP is GDP calculated if the price level did not change. When we calculate the GDP, we are going to calculate it price multiplied by quantity. So quantity is the production which we are having in some time period. For example, we have quantity which we produced into price, and this is summation Qi into Pi. So this is the formula to calculate GDP. When we think price is not going to change, or when we calculate the price GDP with the previous year prices or some base year prices, that is called real GDP, as we assume that price has not changed. Real GDP per capita is often used as measure of standard of living. It is better method from many other methods to study the standard of livings. Nominal GDP unadjusted for any price level change. For example, if there is a change in price only, no change in quantity, we will get come up with higher GDP, but actually there is only price changed, the quantity is not changed. So we a better measure is to calculate the real GDP. Well, concept is for normal GDP is we counter when price changes, we change our GDP and we take new prices and new quantities to calculate the nominal GDP. We do not adjust price increase, so we come up with the nominal GDP relationship. Nominal GDP of time t period is equal to PT into QT. This is current time period. T means current time period. Okay. Real GDP is equal to PB, new prices, old prices into T. This is our current quantity, but we are taking the prices of some base period, B for base period. So base period means we are having some year with ideal level of prices in which there is no much fluctuation in prices. There is now emergency condition, there was no war, there was no drought, so we take that year, and that year is not too much away from current time period, so that take base period. Basically that is adjusted by the statistician, where here we can explain it. PT is the price in year T, PB is the price in base year, QT is the quantity in year T. GDP deflator. It is used to convert nominal GDP into real GDP. When we are having nominal GDP, then we have to use some tool to have it in real GDP, so we can have some better decision making. So we use GDP deflator. How it is calculated? GDP deflator or implicit price deflator reflects the amount of GDP that is associated with change in price level. When there is a change in GDP but there is a change in price, so GDP deflator deflate that GDP, nominal GDP, toward at the level at as much as the price changes. So GDP deflator is equal to value of current year output. It means current GDP divided by current and nominal GDP divided by that is your real GDP. This is real GDP. So multiplied by 100, that is called GDP deflator. In this formula we can actually have real GDP by dividing nominal GDP with GDP deflated divided by 100. So nominal GDP is equal to real GDP multiplied by GDP deflator divided by 100. Example, you can see that there is nominal GDP in this example is this, GDP deflator is this. We can calculate real GDP by dividing this. This is our numerator and this is our denominator, and divided this by 100. So we can have our real GDP. Okay, components of GDP. There are 4 components. You have already heard about. GDP is equal to C plus I plus G plus NX. C are the consumer expenditures which we made as a household. We buy our kitchen expenses, we buy clothes, shoes, we buy grocery items, other items. That is C. I is for investment expenditures are made by business people. That can be government expenditure, government investment or private investment. So this is I, investment expenditures. Okay, G is the government expenditures. Whatever is going to expend by government is called G. NX is the net export. They are equal to exports minus imports, and this can be positive. If we are more exports, we come up with positive sign. If we come up with more imports, then it will be negative. It means we are going to spend more on foreign goods. GDP and other income measures. We are going to national income, to personal income and disposable personal income. National income is the income received by all factors of production used in the generation of final output in an economy less capital consumption allowance. So what is GDP minus our capital accumulation or capital consumption allowance? We have national income. So this is GDP minus, we simply call it depreciation, that is called national income. Capital consumption allowance is the estimated amount of depreciation. So we have minus it from GDP, that is our national income. Personal income is the measure of household income, what we are getting, actually what everybody is going to get as a whole, that is personal income. So this is ability of consumer to make purchases. Measure of national income to households. So personal income is equal to national income minus indirect business taxes. Corporate income tax. What is this? We can see it in the corporate finance. Here short term corporations have their own taxation system. Central Bureau also tax the corporations for their separate identity, that is called corporate income. Undistributed corporate profits, the profits which companies do not distribute, plus transfer payments, what we get in form of pensions, zakat, or anything which we are having in form of without consideration, that is transfer payments. Personal disposable income, it is personal income minus personal taxes. So we are going to minus personal income from personal taxes, that can be indirect taxes which we day-to-day activities we actually pay, that is personal disposable income. This is actually the income which we get and which spend and which get the benefit from which. Okay, thanks a lot for watching. Please hit like and subscribe for more videos. Thank you.